G'day, I'm Paul Sanger, your host for today's Due Diligence webinar, where we will delve into the intricate relationship between geopolitics and global markets, exploring their impact on inflation, interest rates and commodities. Additionally, we're excited to discuss SSI's latest investment endeavour, the Sequoia Commodities Series 23, offering an alternative and cost-effective avenue to capitalise on the ongoing commodities boom. Leading our discussions today is Blair Kirkhope, bringing with him over 22 years of financial markets expertise. Blair heads Sequoia Specialty Investments, a prominent structured product issuer in Australia and a wholly owned subsidiary of the Sequoia Financial Group, ASX code SEQ. Throughout the webinar, Blair will navigate us through various facts of the Sequoia Commodities Series 23, including analysing the geopolitical landscape's impact on global markets, encompassing inflation, interest rates and commodities, providing insights into the projected duration of the current commodities trend and its underlying factors. He will outline the investment objective of the Sequoia Commodities Series 23, highlighting the key features, benefits and associated risks of the Sequoia Commodities Series 23, offering guidance on how to engage with and invest in this product. We want to make this event as interactive as possible, so please ask questions via the Q&A box at the bottom of your screen, and I will endeavour to answer as many of those questions as we possibly can. Without further ado, let's extend a warm welcome to Blair as we eagerly await his insights. Blair, over to you.
Thanks very much, Paul, for that introduction. That's an excellent summary of what I'd like to discuss today. But I guess when it comes to analysing financial markets, we believe that the most important driver of market trends here at Sequoia Specialist Investments is how international capital flows shift between countries and between asset classes, mainly in response to changes in investor confidence. And this is why we believe it always helps to approach financial markets with a global lens or from a global perspective. And this is especially the case today when international trade has become so incredibly important, and at a time when geopolitics is becoming so important from an investor confidence perspective. So it's really from this global perspective that I wanted to present our perspective on markets today. So with that intro, let me begin. So first of all, quickly, just a quick disclaimer: any information provided here is on a general advice basis only. So who is Sequoia Specialist Investments? We've been around since 2010, part of the wholly owned subsidiary of the Sequoia Financial Group. We are considered to be one of the sort of leading non-bank issuers of structured investments in the Australian marketplace. And our main objective really is to provide new sources of either diversification or access to investment thematics which are not generally available to investors through traditional platforms or through the ASX, and we attempt to do that in a low cost or tax efficient manner. And so moving on to how do we actually synthesize some of our investment ideas. We do that through seeking fundamental research through a number of the investment banks with whom we have trading relationships and research relationships. So that's accessing the research across the majors internationally and in the US. So in conjunction with that, though, we do recognise that you do see a lot of personal opinion coming out of the investment banks with the research that they publish. We think it's always very important to always have some level of objectivity when approaching markets, and for that reason, we like to rely on an artificial intelligence system that now has been available for close to 10 years, which is called Socrates, that was developed by Martin Armstrong from Armstrong Economics. And this system is, or computer system is basically very extremely intricate in terms of what it's capable of delivering from a cyclical analysis point of view, as far as trend analysis and also technical. So we'd like to combine the cyclical analysis, which gives us an idea of when we think turning points are likely to unfold from a timing point of view across different markets, and combining that with technical analysis and fundamental analysis coming from the banks in order to formulate what we think could be an interesting investment opportunity for our clients. So it's really combining those things combined, just to give a bit of an idea of the clout of Armstrong, what he's capable of bringing together. He held his own conference, Paul, at the end of last year, where there were 250,000 virtual attendees at 2,000 USD a head. So he was able to generate his own sort of P&L of 500 million for his own conference towards the end of last year. So he definitely has a big following, and used to be at one stage the world's largest financial advisor, advising over $1 trillion. So there's definitely a key player. So without going into too much about the AI system, I wanted to really talk about one of the most important models that he developed, which is actually not an artificial intelligence system itself. This is a separate model outside of Socrates, which I referred to before. It's referred to as the economic confidence model. And really what it represents is the global business cycle. So he by accident discovered that every 51.6 years, you're seeing a shift in investor confidence globally between the public and between the private sector. So when we think of the private sector, we're thinking confidence in privately owned assets, whether it's listed equities, whether it's property, whether it's collectibles, anything that's tangible, anything that's privately owned. During that private wave, and we can see in this diagram on the right-hand side, we're currently within a 51.6-year private wave, which is expected to peak in 2032. And we can see that the confidence in the public sector, which is the government, is starting to shift towards the private sector. And you're seeing this is a cycle which repeats itself every 51.6 years. And at the moment, we're currently within the final sort of 8.6-year wave, which started in 2020 with the start of COVID, and we do expect this to continue into 2032. So it's a shift away from government towards the private sector as far as confidence is concerned globally, that is sort of underlying this trend. So during the public wave, things such as government bonds tend to do well for the people then trust government. During the private wave, this is where volatility rises and governments become very aggressive as they seek their power, slipping through the grasp. But we're starting to see that currently at the moment as there's a little bit more authoritarianism starting to creep up indirectly through a lot of things that have been occurring since COVID. And what you see is this sort of shift between government assets and private assets. So this is the cycle that's driving the long-term trends that we expect to continue into 2032 with listed equities, property, commodities, anything that's privately owned continue to, even art, real estate, antiques, gold and silver, etc. Anything that's privately owned will continue to do well long-term. When we look at the equity market, just as an example, the Dow Jones here, this is since the beginning of the wave. This is like just a quick demonstration over the last 40 years how strong the equity markets have been, especially in the US during that time. It's reflecting this shift in confidence away from government. I will be showing a chart on government debt, but we have seen a major crash across, especially across the 30-year government bond markets over the last sort of 4 or 5 years, and that's again indicative of confidence waning across the government bond sector in response to people starting to lose trust. And so that's a quick summary in terms of the trends in accordance with the economic confidence model. There's expected bullish markets across global equities, commodities, property, private credit, anything again privately owned into 2032. This is the most important driver of trend over the next sort of 8 years, in our opinion. And so let's draw down actually onto this 51.6-year wave. Again, this is all sort of feeds into our commodities investment, which I'll be discussing at the end. But really what it does, it consists of 6 individual waves of 8.6 years each. Why this is sort of important, 8.6 years, if you multiply that by 365 days, that would get 3,141 days, which is a function of pi. So there is actually an element of geometry which is included here. But what we're seeing at the end of every 8.6 years is some kind of shift in the global economy on each of these turning points. And so historically, you never know in advance exactly what's going to occur on one of these turning points. And why I point to this is because on the 7th of May, we had a very important turning point here on the 7th of May, which I'll get to in some detail. But historically, at least over the last 51.6 years, an example of some of the other similar types of turning points that we've had during that time include the 2015. So on this chart, you see 2015.75. That was actually the precise day of the Robert Shiller real estate index high in the US, which 2015, I should repeat that again. So 2015 was 2015.75 was the date that that Russia first got involved in the war in Syria. So that was the first time that they got involved. The 2007.15 was the precise day of the real estate market in the US. So the precise day of the Robert Shiller real estate index on that precise day. The 1998.55 turning point was actually the long-term capital management crisis, where there was a crash in the Russian bonds. The 1989.95, that was a precise high of the Japanese equity market. So each of these turning points happen to indicate major shifts occurring. And right now, like I said, the 7th of May, a very important turning point, which is what we think will be driving markets over the next 3 or 4 years. And so I will quickly get to that now. So the 7th of May. So what has actually occurred on the 7th of May? It was actually the date that happened to be that Putin, who was recently re-elected as the president of Russia, was sworn in on the 7th of May. So that was coincidental. But as far as some of the other things that actually occurred on the 7th of May, we saw that in the Middle East, Israel rejected a Hamas peace deal and captured the Rafah crossing. We also saw that President Biden delivered a speech against anti-Semitism that is rising thanks to covert funding to create civil unrest in the US in preparation for significant upheaval surrounding the election in September. We also saw in terms of international trade, there does seem to be a risk of a trade war between Europe and China. We saw that the European Commission President Ursula von der Leyen warning Chinese President Xi Jinping that the European Union will not tolerate Beijing's market-distorting practices ahead of a three-way meeting in Paris on the ECM turning point. So that was on the 7th of May. So there was a lot of talk around Europe being very upset with some of the subsidies that are occurring in China, especially as far as electrical vehicles and the steel industry is concerned, and posing which she believes is posing a threat to Europe. So they're starting to sort of threaten sort of tariffs in Europe as far as Chinese goods are concerned, and so that's raising the risk of a trade war between Europe and China. So that combined with, as I said, Vladimir Putin was reinaugurated on the 7th of May. We also saw the Rafah crossing. So all of these things were sort of coinciding with the 7th of May, and it's all shifting, creating a sort of a shift in the global economy going forward. And so what the forecast that's coming out of this particular model is that for the next sort of 3 to 4 years, we do expect, accordingly, as a result of a sort of rising tensions geopolitically, for there to be the much rising chance of stagflation globally. So what is actually stagflation? Stagflation represents the case where inflation, the level of or rate of inflation, is exceeding the rate of economic growth. And it's becoming a lot similar to what we saw during the 1970s, really during the time of Vietnam War. So in the event that we see a sort of a major political escalation, especially in Europe or in the Middle East, after this turning point going into the sort of end of this year or beginning of next year, we would expect to see shortages to unfold as supply chains disrupt again across commodities, which would then, increasing commodity prices would then continue to drive or create increasing pressure across the inflation spectrum, which we think will mean that interest rates are going to be forced to remain elevated consequently. So we don't really buy into this argument that rates are necessarily going to be falling in any particular sustainable manner over the next few years, mainly because we think, in accordance with this model, that the risk of war is rising and that there's a real chance that something serious does unfold directly between NATO and Russia during the course of this year. If that does unfold, again, we would expect to see commodities start to really rise very quickly, and that would feed into some of the inflation numbers as well. And so that's why we think inflation is going higher for longer. And just some of the other evidence that we've seen, which provides some indications to why we think this risk of war is continuing to rise, is that in the US, the Congress only a couple of weeks ago, or a month ago, towards the end of April, passed another $95 billion package for Ukraine and Israel. So there seems to be forever funding to support these wars coming in from the West. We've seen, the French leader Macron has been talking about, major issues and is very concerned about what's going on. He also, around the 7th of May turning point, indicated that France was potentially willing to send troops, 35,000 troops, into Ukraine as well. We've seen the Hungarian Prime Minister also talk about thinking it's one step away from World War III. So there's a lot of talk coming from the politicians regarding what's happening there, and we think it's sort of underplayed in the media here in Australia. And we're starting to see it really reflect across. I'm going to flip through some of these other slides, but become reflected in some of the commodity prices as well. So since the 7th of May, which is on this chart here, this is a chart on the BCom index, which is a commodity benchmark index, so diversified commodities across industrial metals, precious metals, even including agriculture. But this vertical line on this chart here being the 7th of May, we just saw commodities really start to break out immediately thereafter. So this was, we think, in response to this turning point, that there's an increase in escalation in what's happening in Ukraine especially. And so when we look at that, combining with what is an extract coming out of the Socrates artificial intelligence system. So Socrates, as I mentioned at the beginning, was an AI system that is capable of mapping different cycles across different markets and also across international war. So this is probably a pretty unusual sort of diagram that I'm showing here. But really what it represents, that top row, the bar chart in that top row under composite, is actually counting the number of cycles that are converging on a particular year. So you can see it down the bottom, you can see the years 2022, 23, 24, 25, 26. And so the greater the number of cycles that converge on a particular time unit, the greater the bar you're seeing on that top line. And so what this means is that the biggest turning point that we expect to unfold from a cyclical standpoint is 2026. And when you see it, this sort of rising bar chart that shows that kind of shape, what that indicates out of this model is that the current trend that is in play as far as the risk of international war is concerned is rising into 2026. So as far as Socrates is concerned, so this is a completely objective cyclical forecast, is that the current trend that we're seeing as far as geopolitics and the risk of international war is concerned, that is likely to continue at least into 2026 with a panic cycle in 2026. So we think that in accordance with this particular AI-driven model, that the current trend that we're seeing in commodities as a consequence is unlikely to come to an end at least until 2026. We think the pressure as far as inflation is concerned and as far as interest rates are concerned is likely to continue into a similar time frame, and it's all driven by geopolitics from our perspective. So when we look at some of the other sort of evidence, first signs or first indications that we're starting to see that potentially economic growth could be falling globally as well, started to fall. We can see in Germany actually that the number of bankruptcies in Germany have actually exploded in April. They're up 28.5% according to preliminary information from the Federal Statistical Office in Germany. The main reasons being high energy costs and a lack of staff. As reported, the wave of insolvencies is progressing at a rapid pace, especially in the construction industry. And there has been talk, has this got something to do with the fact that the Nord Stream pipeline was destroyed a couple of years ago? Obviously that was providing natural gas into Germany. And so now that that's no longer available, that's really increasing energy costs and creating big problems as far as Germany is concerned. Then we've seen, similar to Europe, the US government through Biden and through Blinken have really started to talk about potentially announcing tariffs on imports of Chinese steel. Again, they're worried about what's happening in China in terms of electric vehicles and the steel industry. So again, potentially trade wars on the horizon. And then when we look at GDP, some of the GDP prices, again, this is indicative of inflation. We saw in April, the most recent number that we saw as far as annualised GDP chain prices are concerned, jumped from 1.6% up to 3.1%. So that's indicative of inflation. So we think all of this is driven by shortages. I should say that when we think about inflation, historically we've always thought about it as being a demand-driven feature, but it's really a combination of both demand and also supply. And we think what will be driving inflation going forward would be more driven by shortages on the supply spectrum rather than excessive demand or speculative demand driving inflation. So it's with that in mind. What I might skip to shortly is look at some of the interest rates. What I would say in terms of the interest rate policy that we're seeing from central banks is that what was very interesting during that period in early 2020, during the time of COVID, we saw inflation really take off during that period from sort of 2020 going into sort of 2022. And what was very interesting to us during that period was that no central bank globally really responded to that whatsoever, notwithstanding the fact that inflation was really starting to take off. And you could argue that part of the reason for that was that most countries or most central banks globally probably expected that COVID was going to come to an end. But what we felt was really interesting was that it was only a few weeks after Russia first invaded Ukraine that we saw that the US Fed first raised interest rates for the very first time. And for us, that was a very subtle indication that actually the central banks are watching what's going on. They can't necessarily stand up and talk about it and potentially look to comment on the foreign policy of government. However, they did react at that particular point in time, and we think that's because they do realise that the most important driver of inflation globally is actually international war. So that was part of the reason behind the policy, not that they can state it publicly, but the timing there and coincidental timing is very interesting from our perspective. So when we look, let's sort of drill down a little bit on interest rates as well. So this chart here is looking at the US discount rate. So this is a sort of a technical chart. You will recall I was talking about the current cycle in terms of international war likely to continue into that sort of 26-27 period. So our expectation, at least when we just look at this uptrend, this green uptrend line, is for us or for US interest rates to at least test the bottom of that line, which is up at about the 7.5% level. The figures that I've mentioned at the top there, the major resistance at 6.25 and support at 4.5, that's 6.25%. That's a number that's come out of the Socrates system. So we're seeing major resistance at 6.25. So at least testing there going into 2027, but I would expect 7.5. Just looking at the technical chart here as far as US interest rates are concerned. Again, this is quite a contrarian outlook. A lot of what you will see in terms of the analysts' reports coming from a lot of the banks, a lot of them have a lot more of a sort of outlook looking at either flat interest rates or falling interest rates. That's certainly not our view. We think that rates are going higher for longer for the reasons that I mentioned before. And again, so this here is a similar type of cyclical array that I showed before. So again, just to remind us, that top aggregate row, this is counting the number of cycles that converge on a particular time unit. The number of cycles that converge on a time unit, the greater the likelihood of a turning point unfolding during that time, which means either a higher or low. If we look at the current trend, we have a trend that's going higher currently, so we expect that the next turning point as far as interest rates are concerned will be 2027, with a directional change this year. So we think that's in accordance with the 7 May turning point, so we would expect that to be going higher. I would say with one caveat, there is always a chance that you might during this particular period get perhaps one small rate cut. You know, you could get a 25 bips rate cut, but we think that the long-term trend here that we've seen since 2020 in terms of rates will be going higher into 2027, and that's fully in line with this objective AI-driven timing forecast that is based on absolutely no opinion whatsoever. So we're sort of combining timing combined with technicals in order to come up with a forecast as far as interest rates are concerned. So I wouldn't be counting on any rate cuts soon as far as the US is concerned. And then when we look at bond yields themselves, we think they're going higher for longer. This is just a 10-year yield chart. You can see that the trend since 2020 is going higher. So this is just on yields. When we look at the 30-year bond on the price, as far as prices are concerned, this is what I wanted to show before as well. You can see the huge sharp drawdown since 2020, up from that 188 level down to sort of 113. We're now trading at about 116 on 30-year bonds. But that's a major crash. That's very indicative of a bear market. We are not going to be seeing new highs in 30-year bonds. We think this bear market is here to stay, going into 2032 at least. And part of the reason for that, we've got to ask fundamentally, why is that, apart from just the cyclical analysis and technicals? We have to think about how much liquidity do we really think is going to remain in the government bond sector going forward. So we think about who are the most important buyers of bonds historically. At least in the US, it's been China. And we know that China has been looking very closely at what's been happening with Russia in terms of their central bank reserves are concerned and the extent to which they have been confiscated. And so they have been actually selling down their own treasury portfolios. And that's obviously in advance of potentially anything to do with Taiwan. Should they look to do something with Taiwan, they know, of course, there's absolutely no chance that the US would ever look to repay that debt if China was to invade Taiwan. Not saying that will actually occur, but if it did, then that's certainly the case. And then we would think, okay, how much debt within the US needs to get rolled over the next sort of 12 months? And at the moment, there's 10 trillion of debt globally that will mature during 2024. And so when that gets repaid, new debt has to get reissued into the market in order to fund the repayment of the debt that is maturing. And when that new debt is reissued into the market, it goes to auction and a price is set. And if one of the largest buyers of that debt historically is no longer in the market buying that will have a major impact in terms of setting the yield is concerned. At the same time, you will have life insurance companies and pension funds globally that are sitting on massive losses on some of their bond portfolios, given the spike in yield since 2020. So to what extent they will be there rushing in to buy some of this debt at the same time, we think is causing a sort of a major shift as far as the supply-demand dynamics are concerned, as far as the bond markets are concerned. So that's why we think bond prices will be going lower for longer. And then this is just to show a bit of a diagrammatic representation of what I discussed as far as China selling off their US treasuries since pretty much 2013. So they're gradually offloading their position. And what are they doing in turn? So obviously, as I said, they want to be investing into assets that don't pose the risk of becoming confiscated in the event that they were to enter some scenario with Taiwan. We can see ever since sort of that period ever since 2018, but most recently over the last sort of 12 to 18 months, they really started to pick up their gold supply. So the level of gold that they're holding within the Chinese central bank is gradually increasing over time. They know they're physically holding gold, it can't be confiscated. So that's again part of the reason why we're seeing such a strong rally in gold, which we think will continue, partly because of this reason. And so let's just quickly shift from that to equity markets as well. what I wanted to sort of demonstrate here is sort of refer back to the economic confidence model that I touched on at the very beginning. So we've seen the 30-year bond market crash. We've seen some of these commodities take off, but we've also seen, notwithstanding a lot of negative sort of bearish sentiment in the market generally, we've seen equity markets remain extremely resilient and extremely strong, notwithstanding what would appear to be quite strong headwinds. When we look at the level of inflation globally, but equity markets are absolutely flying. Interest rates have been, rising quite substantially, but equity markets have been rising. And so I think this dispels a bit of a market myth that is propagated by a lot of, especially the talking heads on TV. They think that, if interest rates rising, equity markets will fall. That's just not the case. So notwithstanding the fact that we think that interest rates will continue to rise going into 2027, that does not mean that the equity markets are going to undergo some enormous crash. Yes, you might see some kind of correction, especially if you see a direct confrontation between NATO and Russia, or if you see things really expand in the Middle East, then yes, you could see a correction. But we do not see any major crash or bear market unfolding in equity markets. And part of the main reason for that is when you look at the size of the bond market compared to the equity market, it's 10 times bigger. So you only need a small fraction of capital to leave the bond market and find its way into the equity market in order for it to really provide some bullish support for that market. And that's part of the reason why we believe we will continue to see strong equity markets over the long term. Yes, you will get some, you will get some pullbacks and you get some corrections in the meantime potentially, but they will just represent buying opportunities. In our opinion, if you get a 10 to 15% pullback in the Australian market, that's a buy opportunity for us. The same with the equity markets in the US. So just wanted to really highlight that point. We've seen that's the Nasdaq, and when we look at the currencies as well, this is what for us is really indicative of how international capital is starting to really, or has continued to shift over recent years in response to this question of confidence. So when you're an investor, let's imagine that you're managing a portfolio for a large pension fund or a large asset allocator globally, and you're looking, where should I deploy capital region, around the world? Where do I feel most safe about where my capital should be placed? Would is Europe on the edge of entering into some conflict with Russia? Japan is very close to North Korea, who are sending sort of missiles into the Japan Sea. We've seen the UK as well, very much involved with NATO. So all of these things combined, but when you look at the US, its distance, it's also got the strongest economy globally. It seems to be doing very well in terms of its economy and its distance from what's going on in Europe and in the Middle East and in Asia. So we think that's why you're seeing the euro remain extremely weak, or the US dollar versus euro remain extremely strong, because capital is moving away from Europe into the US. And the same goes for Japan. Capital moving away from Japan into the US, the same with the pound and the UK. And that's really demonstrating or representing a concentration of capital away from these regions into the US, and is again why we believe that the US equity markets especially will remain particularly strong going into 2032. So we think that long-term trend in US equities especially is a combination of capital leaving bond markets going into equities. If you look at Microsoft, is it safer than the US government when you look at its balance sheet? Absolutely. And not just that, but also capital concentrating from different regions in the world into the US as well. So those two things combined will continue to provide long-term support for US equity markets. So that's what we're saying there. The US dollar will remain king for quite some time, and at least into 2028. That's the forecast as far as Socrates is concerned. So that's it in terms of our sort of looking at how geopolitics are sort of influencing different asset classes and some of the interplays and interactions that we think are driving markets. Let's now really drill down into the commodity markets itself, where we think a big opportunity currently exists. And so this chart here is coming back to the Bloomberg Commodity Index benchmark. What I wanted to show here, this is a long-term chart going all the way back to 2000. My only point here is to say that we're a long way away from the all-time highs. So it's not like we're making big all-time highs in commodity markets. We pretty much saw a bear market from 2008 going into 2020 in commodities. And it was really only since we started to make sort of new highs going into 2022 that this market started to enter what we believe is a new bull market. And we think that this is actually representing an entry point opportunity for investors who don't have any direct non-equity related commodity exposure within their portfolios. And we find that when you look at a lot of the model portfolios on some of the major platforms in Australia, you will typically find that they won't generally include any direct commodities exposure. So we think there's always a place, especially right now, given what I've been talking about as far as geopolitics are concerned, the commodities really should find a place into a portfolio. And so I'll be discussing that shortly. But yeah, we're not buying the high. There's a lot of upside potential. It's at least 135% from here just to retest the 2008 highs. So let's draw down into some of the individual commodities. We can see this is probably a familiar chart to some of you. As far as gold is concerned, the 2100 level there was a really strong level of resistance that was residing for some time. It took quite a number of years for it to break through. The general rule of thumb is that once you attempt to knock on heaven's door or test resistance a fourth time, it tested 3 times, but fourth time is usually the charm that you would break through, and that's what we've seen here. It's broken through 2100 on the 4th attempt, and so we think this is going higher. As far as some of the sort of the outlandish, huge sort of forecast in terms of how far gold could actually go, we think over the next 2 to 3 years, going into that 26-27 period, best case scenario, you could be up at that $4,500 level within the next 2 to 3 years. So we think there's a roughly sort of 80%. Probably 80 to 90% move potential from here in the event that you get a major escalation as far as international geopolitics are concerned. So there's a lot of upside potential here as far as gold, but we're not going to be up at the 20,000 level or anything like this.
And maybe just a question here, particularly with gold, it's taken a lot of people by surprise. The rally, certainly the rally that we've had this year, we're not seeing massive inflows into gold ETFs. Gold stocks have not particularly moved aggressively with this move. So what I understand you're saying is a lot of this gold movement is back to what you said earlier, is China getting rid of that US government debt, replacing it with gold. We have seen ETFs in China go nutso. The gold move is being driven by that shift of policy with China. Yeah.
No, absolutely. That's the central bank policy, not just in China, but other central banks of the globe are following a similar approach as well. But you will see that notwithstanding, a really strong US dollar, gold is continuing to run higher. Yeah. And it really does, for us, it's not something that reacts to inflation, it's something that reacts to geopolitics. It reacts to a loss in, or a reduction in confidence in governments around the world. So people are looking, where can they safely store their wealth? And in a way which is potentially tangible as well. So you're seeing even the average investor, there's a lot of people looking to hold, gold bullion, or how can they get invested. So that's sort of a trend that's happening globally. And I think that's likely to continue as the current trend as far as geopolitics are concerned going into 27. Yes. So we think that trend there is here to stay. When we look at copper, we saw again copper very, very recently broke out above its sort of $5 level. So that's it sort of came back to sort of retest it. So it had that initial breakout. It's now come back to sort of retest that. You could argue that there are sort of range of different sort of fundamental reasons for that. We know that copper is very much used in chips as far as artificial intelligence is concerned. The current theme that we're seeing there with the huge rally in NVIDIA, for example, that's all feeding back into potentially the copper price as well. We know copper's used in electric vehicle batteries as well. It's also used as far as the casings on ammunition as well. So does that feed into it as well? I'm not sure. But we've seen the breakout in copper. When we look at oil, we saw the low in 2020. It sort of broke out up into that sort of 130 level going into the beginning of the war. in Ukraine, and it's sort of pulled back since then, forming a low in 2022. And we think this is slowly but surely starting to turn the other way. So we think, at least from an entry point opportunity, we think it's good and will remain relatively strong as far as oil is concerned. Natural gas, we think, has a huge upside potential. We're currently trading at about $2.80 here as far as that natural gas price is concerned. But the all-time here is up at $10. I'm not saying we're necessarily going to retest that, but just shows there's a lot of upside potential, and that's really feeding into what's happening in Europe as well. So if we do see a bit of a shortage unfold in natural gas at any point between now and sort of the end of 2027, we think that's going to really rise the chances of another major rally in natural gas as well. It's starting to move again more recently over the last sort of 4 to 6 weeks. So that's as far as some of those individual commodities are concerned. So what I might do is just move to the actual investment that we currently have open, which is Sequoia Commodities Series 23. So I'll get to the terms. So this is an 18-month investment where we will lend 100% of the investment amount to end investors on a limited recourse basis. So that means that the loan does not need to be repaid at maturity in the event that the underlying commodities portfolio falls during the investment term. So that's the nature of the limited recourse nature of the loan. The interest rate is 5.9% per annum. So we think that's extremely attractive as far as the headline interest rate is concerned. So that's prepaid upfront for the full 18-month term. So if you just go 1.5 years times 5.9%, that would be 8.85%. There's an application fee of 1.1%, which is payable upfront as well. So the total upfront investment cost is 9.95%. So if we just take one example for $100,000 of investment exposure, that would be costing the end investor $9,950. And what do they get for that? They will get $100,000 of investment exposure to a commodities index that was created by BNP Paribas, which is called the BNP Paribas Strategy C52 10% Index, which I'll get to shortly. But it represents a diversified portfolio of 13 commodities and cash. And then at maturity, at the end of the 18-month term, what we do is we look at the performance of that index, apply it to the leveraged investment amount, so in this case at $100,000, yep. And at maturity we'll pay a coupon calculated by reference to the performance of that index and the $100,000. So just take a quick example, just ignoring the impact of currency here, which I can talk through later, but including any changes in currency, then let's assume that the performance is up, say, 12% after 18 months. On that $100,000, we'll be paying a coupon of $12,000. If it's up 15%, it'd be $15,000. If it's up 20%, it would be $20,000. If it's up only 5%, we'll be paying $5,000 as a performance coupon at maturity. If it is negative at maturity, then there's no coupon that's payable, which means that end investors would lose effectively 100% of their initial upfront cost, which is the $9,950. However, if the index, for example, fell 50%, they don't have to repay the negative 50% on the 100 grand. They just walk away from the loan. So they don't take any risk in relation to the loan from that perspective.
All right, just make sure I understand that. So to make sure I understand, even if the commodities portfolio falls, the investors can never lose more than the upfront costs, which will, in this example, 9,950.
That's correct. That's correct. And the reason for that is because inside the structure there is some inbuilt protection inside the structure to ensure that's the case. So I'm happy to talk through that in more detail, but that's absolutely the case. So really, let's talk a little bit around some of the rationale behind why it is that we're offering this investment, apart from the fact that we are very bullish on this market itself. But as I started at the beginning, what we'd like to do is offer this as a satellite allocation for investors. We're not necessarily saying that they should go and sell a big part of their strategic asset allocation. We think that to the extent that they have some excess cash available, it can make sense to add this as part of your portfolio, but only really making a small allocation. It's really designed to be a very small allocation within the portfolio. Yep. Because it is a 100% leveraged investment. It is a high risk investment. You can lose 100% of that 9,950 in that example. So you're never going to allocate a big part of your portfolio to that amount, but it does enable you to get a big exposure for a small upfront cost. So that's what we're trying to do there. And then what I should mention is that the prepaid interest is tax deductible. That tax deduction is accrued over the 18-month term. It's unfortunately not something that can be claimed up front for this year's tax return. However, what it does do is that if someone is in the top marginal rate and they do invest outside their super, what it does do is actually reduce the actual worst case after-tax downside risk. So we think of that example, 9950, let's assume an investor's in the top marginal rate, they get a tax deduction for their interest. Once they get the benefit of that tax deduction, the worst case after-tax downside risk might be closer to 6,000 or 6,500, but they're still getting all the upside on the 100 grand. So from a risk-reward point of view, we really like that sort of asymmetric sort of payoff potential that you get with these types of investments. As I said, the downside risk is limited, but there's no cap on the upside. It is also eligible for self-managed super funds. We also do offer daily liquidity, no lock-ins. Clients can take profits early or get out early at any particular point in time. So that's certainly what we did with a number of investments that we had running going into early 22. We got nearly all investors out when we saw a big spike in commodities, and that was all about 9 months before maturity on a number of those products. So that's what we like to do. If we do see a big move in commodities over the sort of next 18 months, we would normally be recommending or advising clients to at least consider taking profits early. And our actual investment objective as far as the issue is concerned is for the underlying commodity index to generate a return of 10% over the investment term. And if that does unfold in accordance with our sort of investment objective, I should say 20% over the 18 months. If the commodity index generates a return of 20%, then the performance coupon that would become payable would be $20,000. So that would represent effectively doubling of your money over the 18-month term. So let's go to the actual index itself. So it consists of 13 commodities, including copper, zinc, aluminium, nickel, lead. So they're all your traditional base industrial metals. We also have gold and silver. And then the traditional sort of energy sector, including WTI and Brent, crude oil, gasoline, low sulfur gas oil, and diesel and natural gas and cash. So very diversified across the portfolio. What I should say is that this index does include what is called a 10% volatility target mechanism. So the objective here is to keep the volatility of the index to 10%. The way it does that is by, on a daily basis, it will change the allocation between commodities and cash so that the combined portfolio as a whole has a volatility of 10%. And it's because of this mechanism that we're actually able to obtain a very cheap hedge for us as an issuer when we hedge the issuance of this product, and enables us to issue a very reasonable interest rate of only 5.9% per annum, notwithstanding the fact it's 100% leverage, with no margin calls and no initial margins. So the reason for that is because there is a volatility mechanism that is built into the index itself.
Just a quick question there, Blair. Obviously, you talked a lot in your early part of your presentation that one of your biggest concerns is geopolitical risk over the next few years. If we do have geopolitical risks, the impact of that, commodities go higher. When I look at some of the commodities you have in there, history will tell you if there is geopolitical unrest and war, oil prices go through the roof, gas prices go through the roof. Some of the lead commodities, copper, gold and silver are seen as safe haven. So it's very geared to, if you think that's a scenario, this is a great way to play it rather than try and buy the individual commodities itself or stock. So
exactly.
Interesting the way it's been constructed.
No, that's exactly. So we think energy is likely to benefit in the event of war. We've seen that always the case historically. Also, when Russia first invaded Ukraine, you saw all the energy sector take off.
Absolutely.
You saw gold take off. But base metals are really starting to come back. Nickel, zinc and copper's obviously broken out. But some of those base metals are starting to come back as well to the extent that they're used as far as manufacturing is concerned. So let's look at the actual performance of that index itself, just to give investors a little bit of an idea what kind of return you've seen historically and maybe potentially what to expect going forward. So on this chart here, you'll see the low to the high, that's 67%. That was over effectively a 2-year period. You saw a 67% rise from the low in 2020 up into the high in sort of June 2022. I'd say that's the absolute best case scenario that you could ever imagine over effectively a 2-year period. We're not suggesting that's going to occur during the term of our investment. It's theoretically possible. Our objective, as I said, is 20%. We're looking for a 20% move over 18 months during this investment term. If that does unfold, investors would be doubling the money during that investment time horizon. What we saw since the highs there in sort of 2022, we've seen the market sort of pull back into the beginning of this year, and now we've started to see it move the other way. So we think this is likely to continue. This chart was actually drawn probably a couple of weeks ago, so it was actually before the recent breakout. You'll see it's currently up at about the 245 level, but so that little dip at the end has been reversed. So it's a couple of weeks old, this chart, that's why. But yeah, just to show a little bit of an idea what kind of upside, what kind of performance we've seen historically could be possible. We think the entry point opportunity still remains. And then in terms of investment cost, as I said, the minimum here is $9,950 for $100,000 of investment exposure. If an investor wanted, for example, $500,000 of investment exposure, it would cost $49,750, for example. And now let's look at some of the hypothetical scenarios in terms of what level of performance coupon could become payable depending on the performance of the index. So the break-even point here really is 10%. So if the index is up 10% or 9.95% at maturity, adjusted for currency, then we would expect, clients would receive exactly that amount returned back to their account through a performance coupon at maturity. So they would break even in that case. As I said, if it's up 20%, it would be $20,000. If it's up 30%, it would be $30,000. And there's no cap on the upside. Alternatively, if it's negative, then clients just walk away. They've spent the $9,950 in terms of prepaid interest and the application fee. And that's their maximum risk and the maximum loss that they can incur. This shows the application form. So in terms of risk, as I said, there is the risk of 100% loss in relation to the upfront cost.
Yep.
Clients do need to be bullish on the commodities sector itself in order for this to perform well. So the underlying index has to go up in order for investors to generate a return. And of course, there's absolutely no guarantee that that will actually occur. So further of these risks are included in the PDS. I should mention, to the extent that there are investors who are retail, this does include a target market determination. So any retail investor needs to ensure that they are within the target market before they can invest, and that is something that they can discuss with their financial advisor. And so this particular investment closes on the 28th of June. So there's another 4 weeks to go before we close this, and we'll actually trade on the 5th of July. The actual details, including all the offer documents, the target market determination, the PDS, and the investment flyer can be seen at our website, which is shown there. So that's it from me, Paul. Any questions?
Yeah, just a couple of questions just to reiterate some of the points you made, because I think they're important. I asked this question earlier. So what's very clear there is that investors can never lose more than their upfront costs. So if the quantity index falls 70%, all they lose is their initial 9.95%,
correct,
which I think is quite key. And I think you did answer this earlier. Can investors get out early? If commodities go for a massive tear, is there the opportunity to cash that in and get out
Absolutely.
of this?
So daily liquidity, with one caveat, it's on the basis that all the underlying commodities that are included within that particular index are actually open for trading.
Okay.
So to the extent that any particular market was shut for any particular reason, then we would not be actually able to execute the unwind. So that has happened before.
Yep.
And in fact, it did occur when we actually placed an unwind or an unwind with our bank that we were using to hedge the product in prior years. During 2022, nickel actually was going through a major disruption, and the London Metals Exchange did close the exchange for 2 days. So we had to wait 2 days, but after that was reopened, we could process and execute the unwind. So it's on that condition.
And again, just remind us, if you've got a self-managed super fund, is this type of investment eligible?
It is, absolutely.
Yeah, it is, absolutely. Yep. Okay. And the last one was, is the prepaid interest tax deductible?
It is tax deductible, again with the caveat, you can't claim it up front this year in this year's tax return. It does need to be accrued and amortised over the term of the loan.
Fantastic. Well, that's all the questions I have. Many thanks for the presentation today. For all the investors online today, we will send you details if you're interested in this product, or if you want to learn more and have questions for Blair, do not hesitate to reach out to Blair directly. The offer closes on the 28th of June. But as Blair says, if you are bullish on commodities and want to leverage play or a cost-effective way to capitalise on that, this is certainly a product that you probably want to consider quite closely.
Thanks very much, Paul.
Thanks, Blair, and thanks everyone for tuning in today. Have a great day.